Good morning, good afternoon, good evening. Thank you guys once again for joining the 980s podcast hosted by yours truly, Kevin Thompson, founder and CEO of 980 Capital Group. Thank you guys for joining me. As I always say, subscribe to the channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@980capitalgroup.com. Send us your questions. Go to the website at www.980capitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, engage, and also entertain. Follow us on all social media channels at 9iCap or at MLB to CFP. Today, we're talking about some of the biggest 401k mistakes that I see. I'm going to go in depth. It's going to be quick, but I want to give you this knowledge because I think it's powerful. And I don't want to see you making those same 401k mistakes. So without further ado, let's get it. So let's get right to it. The 401k. Now, we all know what a 401k is. Most of us have it with our companies. Most of us are getting some kind of a match within our companies. But we've spent so many years building up this asset, but one wrong move can cost us thousands of dollars. And it's important to know what those wrong moves will be. So today we're talking about 6 of the most common things I see within 401k plans. Some of the mistakes I see people make, whether you're still working, retiring soon, or just thinking about taking more control of your money. This episode is for you. So let's just start here. 1, not knowing the 401k rules. The first mistake is not knowing how your plan is organized or reading exactly how your plan is structured. Every plan is a little bit different, but there are a few things that most people often overlook. The first one is, let's just say hypothetically you have a loan on your 401k. If you have a loan on your 401k and you leave your job, and it's still outstanding, that loan becomes a distribution. It counts towards your taxable income, and it becomes immediate distribution, and it may even be penalized. So it's important to understand that if you leave your job, or if you lose your job and you have an outstanding loan, that loan becomes an immediate distribution, and it may be taxable. 2, this is important. If you're 55 and older, and let's just say you left your job and you want to take withdrawals, you leave that money inside the 401k plan. Why? Because it allows you to take penalty-free distributions after 55 years old. That's one of the biggest reasons why many people leave their accounts inside their 401k plans, because they get access to the penalty-free distributions if they need those dollars. Once you move those dollars over into an IRA, it becomes more and more difficult, and those dollars may be penalized. Why? Well, you can forego some of those penalties, but you have to do it in what we call an SEPP, or substantially equal periodic payment. These rules can allow early withdrawals within an IRA or a 401k, but you've got to follow a strict schedule exactly. Change it early, it triggers back taxes and penalties. So knowing these things, knowing these nuances can help you save headaches, taxes, and money. Sometimes keeping your funds inside the plan actually makes the most sense. I've had multiple conversations, especially from people that are in the government space that retired prior to 60. I said, hey, you may need access to those funds. Let's keep those funds inside the thrift savings account right now, because you may need access to them. So that was a powerful move. Again, not all rollovers are conducive to making good decisions. So I implore you to have someone on your team, maybe a financial advisor or someone that you can get some information from to make some good decisions on your side, so you know if it's in your best interest or not. Now that leads me to part 2, which is proper rollover techniques. Rollovers done the wrong way can cost you thousands. I've seen it time and time again. I can't tell you how many times I've seen it, because again, I've seen things go sideways because someone took a check made out to themselves personally, and instead of putting that money into the custodian directly, they put that money into their bank account. Now, there's this thing called the 60-day rollover. So if that money is made out to you, you can put that money back into an account, an IRA. but it has to be within 60 days. Now, you're going to receive a 1099 from the institution and a 5498 from the custodian that we're supposed to go. So you got to make sure that you have those for your CPA so you can offset that impending tax. Always, I prefer this. Always do a trustee to trustee transfer. It's cleaner. If the money touches your hands, like I said, you have 60 days to put it into an account or it becomes a taxable event. And if you're 59 and a half or under 59 and a half, it can be taxable and penalized. So a simple administrative mistake can cost you thousands. Don't let the IRS teach you that hard lesson. It's important, and your financial advisor, if you're working with one, should help you with this trustee to trustee transfer, because most likely what's going to happen is they're going to say, your 401k company is going to say, we're going to make this check out to the custodian, and they're going to send it to you directly, even though it's not made out in your name. You're going to have to put that check into the custodian where you're doing the transfer from. You can technically have them send that directly to the custodian, and they'll handle it that way as well. But it just depends. Some 401k providers say, no, we're sending it directly to you, your mailing address. The other people may say we can send it to the custodian. But it's important to make sure that you do this one thing correctly, because if you don't, it may cost you thousands. This was important to me, paying more for less. Quite often, people will move their 401ks over to an IRA, not understanding exactly what their 401k was providing. In general, their 401k is offering some institutional share classes, which are very inexpensive. You get break points based on the fact that these are institutional share classes. So with that being said, know exactly what you're investing in. Know that if you're moving your 401k over to an IRA, what are you getting in the IRA account? Are you just getting improved performance? Are you getting flexibility or planning potential? That's a possibility there. What value are you getting from moving these assets over? In general, I like to make sure that when we have these conversations, we're making, of course, we're adding more value, because when we move money over, it's not just about the portfolio. It's about the overall planning environment that we offer here. But in general, when you're moving these assets over, you need to know exactly what you're doing, what you're getting, what's the cost that you're moving them over into, and is it delivering more value? That could be a downgrade, not an upgrade. So it's important and imperative to know exactly what your 401k plan had and what you're moving into. Another one is not understanding your risk tolerance. Now, quite often when you're in a 401k, many of us are just going into some kind of target date fund, and the older we get, the less risky it becomes. And ultimately, when we get to that retirement age, the closer we get to it, we're going to be in more fixed income, so we're not necessarily as volatile. So depending on where you are in the phase of life, you may start saying, okay, I want to move from my 401k where I'm in this 2040 fund or 2050 fund, and then now it's 2035 and you move it out, and now you're going to a different asset, but not knowing exactly what your risk tolerance actually is. I like to do a bit more in regards to risk tolerance, because I don't see your 401k as I don't silo it. The most important thing about financial planning is your overall financial balance sheet is a pie chart. It's an entity in itself. So when you have assets in checking, real estate, assets, maybe in some kind of some kind of diversified asset, maybe some commodities, some hard assets, or something that's just non-correlated to the S&P, those actually count in your risk basket. So let's just say hypothetically you have a life insurance policy with hundreds of thousands of dollars of cash value. Well, that's a bond. That's a bond. Your real estate value, that's a fixed income asset. I mean, that could be a fixed income asset, even though it's not producing income for you, but it's actually a fixed income asset or not necessarily a fixed income asset, but it's an asset that's diversified away from equity exposure. So it's to understand that these assets work in different ways. So understanding your true risk tolerance, because a lot of people are going to say, oh, I'm in a 2040 or a 2050 fund. I'm a 60-40 or 70-30 investor. But then when you move it over, now you're 100% allocated to equities, right? I'm not against that, because I often believe that if you're 50 or 60 years old and you're moving an IRA over, it's important to know your risk tolerance because we have another 30 years, 40 years of living. Life doesn't stop today. We have inflation. We have all these different things that are hitting us. It's important to stay invested in equities and possibly have a higher percentage in equities these days because we have to attack inflation. So understanding your risk tolerance is important. So like I'm going to say here, risk tolerance just isn't about what you can't afford to lose. It's about how you react when markets are down 15, 20%. Are you okay with that? That's why it's important to have other assets doing other things that are non-correlated to the overall portfolio. Now, this is where we're about to get a little bit hangry. I didn't say angry. I said hangry. I'm not really hungry, but I call it hangry because there's a lot of financial advisors out there. They're gonna be on your team. It's important to understand who they're working for and who they actually are. What kind of financial advisor do you have? Do you have a financial advisor that works for an insurance carrier? Do you have a financial advisor that works for a mutual fund carrier? Do you have a financial advisor that works for a team of advisors at a wirehouse? Do you have a financial advisor that's actually independent? Why that's important? Because I can tell you this. Depending on where your financial advisor works, I can 100% guarantee I know where your rollover is going to be if you're working with a financial advisor. 100%. Book it. How do I know that? It's because I know exactly how they're thinking. Well, hey, we got to protect the asset. We work with an insurance carrier. We've been taught protection, so we got to protect the asset. We're going to go to annuities and variable annuities and fixed income and all this other stuff, and maybe into a portfolio, maybe in some life insurance. Oh, we work for a wirehouse. We're going to do some mutual funds and some investing. So it just depends on the type of advisor you have to the direction of where your assets are going to go. Now, not in all cases, but I'll say in most, that's the case. And moving your entire book of business, because like I said, or your entire 401k, because I've seen this happen in the past. I've seen an advisor go into a company and try to get everybody to move their money into an annuity. Happened to one of my clients before they retired. A guy goes into the government agency and says, hey, I know you guys, you have all these assets. You can put a bunch of that money into this and get guaranteed income. Well, that's great, but they already have guaranteed income, my friend. They already have a pension from the government and the Social Security benefit. Why do they need another one? But that's just what they were taught. I'm nothing against them, but that's just what they were taught. So before moving these assets over, know what you're investing in. Whether it be an annuity, some kind of private equity, private credit, because a lot of guys in my space are throwing out private equity, private credit like it's just the next best thing. They can all play a role, but not for the entire portfolio. There are trade-offs. The liquidity risk, the surrender charges, and the internal cost all matter. If you can't explain what you own and how it makes you money, that's a red flag. Don't chase what's hot. Understand what you're buying, and your advisor and the people that are working with you, your team should be able to understand the product. I can tell you this. Most advisors in this business don't understand private equity. They don't understand private credit. And even if they do understand the annuities that they're buying, they don't 100% understand how they function. So I implore you, before you make any moves, if you want to move your IRA or 401k over to an IRA, you can do that all day long, but don't put yourself in a situation where you can't unwind an investment product. So I'm going to wrap this up. So the one thing I'll say this, and my last thing I'm going to say is that it's important to understand how your advisor is being compensated. When you do a rollover, we have this thing called the rollover comparison where we have to make sure that you understand exactly what you're rolling yourself into and what you're rolling yourself out of. We compare the costs, we compare the investments, we compare the structures side by side and have our clients sign that so they understand exactly what they're getting. Now with us, it's not about the cost, it's about the value. For us, we do way more than just portfolio management. Estate planning, we have an estate planning tool through wealth.com. We do tax planning, I'm an enrolled agent. We do financial planning, financial consulting, debt management, student planning, education planning. We do all these different things because it's what matters to you. And that comes with the territory. That comes with our pricing. And it's not just about portfolio management or investment management or what have you. It's about all of these things. And that's what we do in regards to providing value to our clients. So if you're working with a financial advisor on a rollover, they should be able to provide you side-by-side comparison of your current plan cost and the proposed rollover. That's not optional. It's a fiduciary responsibility. It's compliance. Transparency protects both sides. Cheap doesn't mean good, and expensive doesn't mean bad. It's about understanding what you're paying for and what the value you are receiving. So in closing, your 401k might be one of the biggest financial assets that you own, so treat it that way. The rules, the rollovers, the risk, and the real cost all matter. You don't get a second chance at decades of retirement savings. If this was helpful and you think it provided some value, share it with a friend, a coworker, or someone who's changing jobs and is thinking about retirement. And make sure you subscribe to the 90s podcast for every week, because we give you insights to what truly matters. Thank you guys for listening. Subscribe to the channel. Go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@99capitalgroup.com. Send us your questions. Go to the website at www.99capitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, engage, and also entertain. Follow us on all social media channels at 99cap or at MLB to CFP. Thank you guys once again. Stay humble, stay safe, my friends. I'll see you again soon.